So, chapter 4 ends with the process of what we call closing the books. Now, remember, the accounting period that we measure, the shortest period is a year. I'm sorry, is a month. The longest period is a year, right? And whether it's a calendar year or a fiscal year, 1 year is the longest we will keep the record for that period. Well, because we're not going to be in business for just 1 year, the very next day after that year ends starts a very new accounting period. And in order to have a new accounting period, you have to close the record on the old accounting period, right? Before you can start a new one. So, how we do that in accounting is we close the accounts that are subject to the periodicity assumption, which are the income statement accounts, revenue and expenses. And because we do the retained earnings statement as well, the dividends account also needs to be closed at the end of the accounting period. Again, we usually do this at the end of the year. Your textbook tries to simplify it by doing it at the end of a month. We normally would not do that. We would wait for the year. But just for you to know, this is real. This is how it's really done. These accounts are called temporary accounts because we have to bring their balance to zero at the very end of the year. When we say we are closing the books, we're basically saying at the beginning of the next period, our revenue account must start at zero. All of our expense accounts must start at zero. And our dividends account must also start at zero at the beginning of every new accounting period. So at the end of the old accounting period, we need to zero out these accounts. That's basically what closing the books are. We never close the permanent accounts. Asset accounts are permanent accounts. They are not subject to periodicity, so we don't measure them based on an accounting period like we do with revenues and expenses and dividends. Assets are on the balance sheet, which are not subject to that. Liability accounts are also on the balance sheet. They are permanent accounts. They do not go through a closing process at the end of an accounting period. And stockholders' equity accounts are also permanent accounts. And remember, retained earnings, stockholders' equity and retained earnings is a permanent account. So we're able to close all of these accounts because we simply transfer all of the balances over to the retained earnings account, which makes perfect sense, right? Look at your income statement. It's revenue minus expenses gives you net income. Where does the net income go? To the retained earnings statement. You subtract out your dividends, the rest is retained earnings. And where does that go? To your balance sheet. So eventually, in essence, we're able to close all these accounts to zero because we're moving those balances at the end of the accounting period into a permanent account. So the results of all those accounts are still with us permanently in retained earnings. However, we can start a brand new accounting period with revenues at zero, expenses at zero, and dividends at zero. So we can keep those records separate from the previous year. And that's closing the books. So let's see how it's done. It's actually a 4-step process, okay, for closing the books. The first thing we do is we close the revenue accounts. To close an account, remember, we simply want to bring its balance to zero. How do you bring a balance to zero? Both the debit side and the credit side need to be equal, right? If you have $100 on the debit side and $100 on the credit side, the balance in that account, whatever account it is zero because there's no balance. Both the debit and credit side equal, meaning there's no balance. One side is not bigger than the other, zero, right? That's a zero balance. So we close the revenue accounts. We need to make the revenue account zero. But we have to move the money in from the revenue account into a temporary account that we called income summary, which I will go over with you in a moment. The second thing that we do is we have to close each individual expense account to zero, meaning that the debit side of the account and the credit side of the account are equal, so the balance is zero. We move all of that into the income summary account. The income summary account is somewhat of a temporary holding tank. It looks like your income statement because what you have in the income summary account is all the revenues and all the expenses. So it's going to look very much like your income statement, which also has all the revenues and all the expenses, right, listed. So the balance in the income summary account will be the profit of the company, the net income of the company. The third thing we do is now that we have our revenue account at zero and our expense account at zero, and we know what the difference is in income summary, we can put that difference directly into retained earnings. And so the third step is to close the income summary account, which is simply a temporary holding tank, into retained earnings. And that makes sense because what's left in income summary is the net profit, right? The net income, which we add to retained earnings anyway, right? We add the net income to the retained earnings statement, which is the same as adding it to the retained earnings account. So that's simply following, in essence, the income statement accounts, closing them out and putting the difference from the income summary account into the retained earnings account. And the last thing that we do is we close the dividends account directly into retained earnings. And so that's basically the four-step process that's involved in closing the books. What happens after this process? The revenue account balance is zero. All your expense account balances are zero. And your dividends balance is also zero, which means the very next day when you open for a new accounting year, you can start counting your revenues all over again from zero. You can count your expenses all over again from zero because you were able to close the record on one year and have these accounts ready to go for a whole new accounting year starting at zero. That's the whole purpose of it. That's the whole purpose. So how does it actually look? Well, all of these are entries. Again, entries go in the journal, so you're looking at a journal, right? Accounting starts in a journal. We made that very clear from chapter 3. Everything we do has to have a journal entry if it's going to have an impact on our accounting record. So here's step one. Step one is we close the service revenue account to zero. Well, service revenue is a revenue account. Its balance would be on the credit side. To balance or to close an account, the balance has to be zero. How do you get a service revenue account to zero? Well, you debit it by the equal amount. Because once the debit side and the credit side are equal, it's a zero balance. What do we do with that money? We temporarily put it in income summary. That's the very first thing. That's how you close a revenue account. You debit the revenue account for the amount that's on its credit side, so they equal. That means the balance is zero, and move that balance temporarily to income summary. The second thing we have to do is close each individual expense account. Notice that each individual expense account is listed here. Expenses would normally have debit balances. So to close the account, which means to bring the balance to zero, we have to put an equal credit, right? Because then if the debit and credit side of the expense account is equal, the balance is zero and it's closed. What do we do with all of the expenses? We put them temporarily in income summary. So look at the income summary account. Income summary account has all of the revenues in it and all the expenses in it, right? All of the revenues are on the credit side of the income summary account. All of the expenses are on the debit side of the income summary account. In the meantime, all of your revenue account is closed and all of your expense accounts are closed, which means their balances are zero. So we no longer need that income summary account because it was simply a temporary holding tank. But your income summary account looks like your income statement. Revenues of 10,600, expenses of 7,740. That looks exactly like the income statement from Sierra Corporation because that's whose books we're closing. Okay. The difference is going to be the net income. If you remember, the net income on their income statement was 2860. So in order to close income summary, again, to close an account, both sides of the account, the debit side and the credit side, need to equal, so the balance is zero. So we move that $2,860 amount from the debit side of income summary. So income summary now is closed. It has 10,600 credits and 10,600 debits. So the balance is zero. And we move that into retained earnings. This makes sense because this is the same as adding net income to retained earnings. The last thing we do is we close the dividends account. The dividends account, as you might remember, has a normal balance on the debit side. So to close the account for dividends, we have to put an equal amount on its credit side because the balance, in order to balance zero, your debit and credit side must equal. What do we do with that $500? Well, we debit the retained earnings account, which makes perfect sense because we subtract it from retained earnings anyway on the retained earnings statement. And that's the closing process. That's the closing process. That's the 4 steps you need to follow. This is what it looks like graphically. Woohoo! The very first step is shown here, where you have a $10,600 credit balance in service revenue. So the debit of $10,600 to service revenue means the balance is zero. When both sides equal, the balance is zero. We temporarily move it to income summary. The second thing we do is we close each individual expense account. Expense accounts have balances on their debit side normally. So to bring the balances to zero, we offset it with an equal credit. We move all of those over to the income summary account. Look at the income summary account. It has all the revenues on the credit side, all the expenses on the debit side. So in essence, it looks like a summary of our income statement. Right. Well, we don't need it anymore. We can dump all of that into retained earnings. So we close income summary. Again, to close an account, the debit side and the credit side simply have to equal. So the balance is zero. That's what closing means. Balances are zero. We move that into the retained earnings account, which is perfect because we add it to retained earnings anyway. This 2860 is the net income, is the profit. We add it to retained earnings. A credit to retained earnings simply means more retained earnings. And we don't need that income summary account anymore. And the very last step, as you see graphically, is we need to close dividends to zero. Again, to have a zero balance in the account, both sides have to equal. So there was a $500 debit there already. We have to put a $500 credit to get this balance to zero. What do we move the debit over to retained earnings? And that's perfect because we subtract dividends from retained earnings anyway. A debit to retained earnings simply is subtracting the dividends from retained earnings. The balance in retained earnings of 2360 is going to equal what's on your retained earnings statement. So there's a connection between the statements and these closing entries, right? Like I said, that's your total revenue on your income statement. The 7740 is the total expenses on your income statement. This 2860 is the net income on the income statement. This $500 debit to retained earnings is the dividends on the retained earnings statement. The end of the retained earnings statement balance is 2360, just like it's on your retained earnings statement. So there's connections between all these entries and what you did on the financial statements for this company. And then after your closing entries are done, we literally do another trial balance called the post-closing trial balance, which simply is a trial balance that should show all of the temporary accounts have zero balances. So again, temporary accounts, right? Your revenue accounts, which are closed, your expense accounts, which are closed, and your dividends account, which is closed, all should have a zero balance. However, your asset, liability, and stockholders' equity accounts will have balances on a post-closing trial balance. Look at how much we did. Okay. 1, 2, 3, and 4 was chapter 3. That was all chapter 3. 5 all the way through what I just went through with you. 9 is all chapter 4. That's the entire accounting cycle that's done over and over and over again. Okay. And you just did it. You definitely need to celebrate. So this is just sort of a summary of all of that. What you've got after that post-closing trial balance, I'm not going to make you do one, but you will definitely see that when you actually see the whole thing, and this is actually cut off here. So what you don't see is dividends, you don't see revenues and expenses, but all those balances would be zero after we close them. Okay. So this is the focus today, doing our closing entries. And here's a company, Hancock, that wants to prepare its closing entries at the end of its whatever period of time this is. Now, normally, again, this would be done at the end of every year. Your book simplifies it, so they're going to say to do it at the end of a month or whatever. Anyway, just follow along. It's a learning process. They want you to prepare closing entries. First step, we close the revenue account. Always, first step, revenue account. This is the revenue account. It's the only revenue account we have here. This $98,000 balance will be on the credit side. So how do you close an account? In other words, how do you get service revenue to have a zero balance? Well, you're going to have to debit the account by $98,000, right? That means service revenue has a zero balance. 98,000 on the credit side, 98,000 on the debit side, zero balance. You move that money temporarily to income summary. So there's a credit of 98,000 sitting in income summary. That's step 1. Step 2 is close your expense accounts. You have to identify your expense accounts. You've got rent expense, salaries, wages expense, and supplies expense. Remember, the closing entries only use those temporary accounts. Revenue is first, expenses are second, right? So the fact that you have these other accounts here, account payable, well, accounts payable is a liability. It's a permanent account. It doesn't go through this process, so you can ignore it. Accounts receivable is an asset account, which is a permanent account. You can simply ignore it. Right? It has nothing to do with what we're doing here in closing entries. So the expense accounts, we have 3 of them. All of these balances are on the debit side of the expense account. So to close each expense account, we're going to have to credit each one and put the total in income summary. In this case, the total expenses are $80,000. So you'll see an $80,000 debit to income summary. And then all the expense accounts have offsetting credits to make each of their balances zero. Again, to close the account is simply to bring the balance to zero. That's it. That's the second thing. But look what's happening in your income summary account, right? If you just looked at income summary, you have $98,000 on the credit side, which represents all the revenue. You have $80,000 of debt on the debit side, which represents all your expenses. So you can just imagine what its income statement would look like, right? 98,000 of revenue, 80,000 of expenses. This company had a profit of 18,000. Right? So that's what's sitting in income summary. And the very third thing we need to do, right, is close income summary. You know, there's 18,000 sitting in income summary, and we move that to the retained earnings account. So we close income summary and move the profit, our net income, into retained earnings. Okay. Income summary is closed because there's an equal amount of debits and credits in the account now. 98,000 of debits, 90,000 of credits is a zero balance. That account is closed. And the very fourth thing we do, the very last thing we do, is our dividends account needs to be closed. We got $15,000 of dividends sitting there. We need to transfer that into retained earnings. And so the fourth thing we do is simply debit retained earnings by 15,000. That makes sense because dividends take away from retained earnings. And we close the dividends account with a $15,000 credit because this 15,000 is on the debit side. So now the dividends account has 15 on the debit side, 15 on the credit side, which means it's got a zero balance and it's closed. And that is closing the books. Questions?